Is it better to drip feed your money into the market every month or bet big at the bottom? The debate between dollar cost averaging and buying the dip has long intrigued investors. We'll dive into the data, and the results might just surprise you. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. So, what's dollar cost averaging, or DCA for short? It's like having a robot invest your money for you. You set it up to buy a specific amount of a stock or fund on a regular schedule, maybe every month or week, no matter what the market's doing. So whether the stock market is soaring high or diving low, your robot keeps buying. It's a great way to smooth out those market ups and downs and avoid trying to time the perfect buying moment. The magic of DCA is that it helps you avoid two common investment pitfalls: panic selling at the bottom and going all in at the top. Imagine the market takes a nosedive. Fear grips investors, and many panic and sell their holdings at a loss. But with DCA, you're only investing a small amount each time. So while the overall value of your investment might drop, you haven't lost everything. On the flip side, when the market is soaring and everyone is feeling euphoric, DCA prevents you from pouring all your money in at once, only to see the market crash later. By investing steadily over time, you're less likely to get caught up in the hype and make impulsive decisions. Now, let's talk about buying the dip. This is when you try to be a market wizard and buy a stock or fund when its price drops. The idea is to score a bargain. But here's the catch. You need incredible timing. You might have heard that it's impossible to time the market. Well, that's because it's true. Even the smartest investors struggle to consistently predict market highs and lows. You have to predict exactly when the stock price will hit rock bottom before buying. And even if you get it right once, twice, or even several times, attempting to time the market over an entire investing career can prove to be a costly mistake. So what does the data say? Let's talk about dollar cost averaging versus buy the dip. A smart guy named Nick Maggiulli did some serious number crunching to compare these two strategies. He imagined two investors, one who invests a fixed amount every month, no matter what. That's dollar cost averaging. The other only invests when the market takes a dive. That's buy the dip. Now, here's the kicker. Maggiulli gave the buy the dip investor superpowers. He assumed this person had perfect timing and could always buy right at the absolute bottom. On the face of it, buy the dip seems like a no-brainer. I mean, who wouldn't want to buy low and sell high, right? If you could perfectly time the market and always buy at the absolute bottom, you'd be rolling in dough. Sounds like a dream, right? But guess what? Even with this unfair advantage, buy the dip only beat dollar cost averaging a little over 30% of the time when looking at long-term periods. Why? Because while you're waiting for that perfect dip, the market might be cruising along, making you miss out on potential gains. Dollar cost averaging, on the other hand, sets it and forgets it. You're invested all the time, so you're capturing all of those ups and downs. It might be surprising that dollar cost averaging often outperforms buy the dip. There were periods where buy the dip edged out DCA, but only by a slim margin. And it was thanks largely to the big dips after the dot-com bubble burst in the 2009 financial crisis. But when we examine longer time frames, DCA is the clear winner, over 70% of the time. Timing the market is like trying to catch a falling knife. It sounds simple enough. Buy low, sell high. But the reality is it's risky and can be pretty painful if you don't catch it right. Let's crunch some more numbers. Another study by JP Morgan found that skipping just the top 10 best days in the stock market over the 20-year period between 1999 to 2018 would have cut your returns in half. When you're trying to time the market and buy the dip, you're essentially playing a guessing game. You're waiting for the perfect moment to jump in, but by doing that, you risk missing out on those incredible market highs. And here's the kicker. We've assumed up until this point that we have the ability to time the bottom of the market. But what happens if you're just a little off? Research shows that if you miss the bottom by a mere 2 months when trying to buy the dip, dollar cost averaging wins the game a whopping 97% of the time. So while buying the dip might sound tempting, the reality is that it's a risky strategy. DCA, on the other hand, is a set-it-and-forget-it strategy. You invest consistently, regardless of market conditions, and the data shows it's a much more reliable and stress-free way to build wealth over the long term.